Hello everyone, welcome to Global Online. So as you know that we were discussing our unit number 5, market financial management. So this is the lecture number 7 on this unit, where we are going to cover the CAPM and capital asset pricing model and arbitrage pricing theory. This topic is related to your portfolio management. Okay. So this is the most trending topic from in our UGC NET management paper too. So here understand it, and if you have any doubt, ask in the comment section. Just hit the like button. Before starting, there is an important information for you that the UGC NET exam is very close now. We have bought the revision crash course on paper 2 management from the for the June 2023 exam. Okay, just a second. So, if you take this course, you will get complete video lectures, complete syllabus notes, which are in downloadable PDF form. Then you will get mock test. Then you will get complete question bank, 2000 plus MCQ question bank, which cover the most expected, most repeated, and all the previous year questions with explanations. Okay, it can be accessed on both laptops and mobiles. The major advantage of this course is if you take the paper 2 management course, you will get paper 1 totally free. So to join, download the Global Online app, and the fees for this course is 10,000, and after 60% discount, it is just 4,000 only. Okay. You can directly enroll. Just download the Global Online app. After downloading, when you are login, you will get the home interface. In this home interface, click on the store button. In the search tab, write UGC NET Management. You will get this course. Just click on it. It will ask for the payment. After the payment, you can access all contents of both paper 1 and paper 2, and all same, and get all facilities which you have expressed. Let's first understand what is a portfolio. The word portfolio you might have heard, but try to hear polio, you all know. Okay, that is different. The portfolio, jokes apart. So portfolio is what is a set of is that part of our business where the person trades in different groups of securities, where different people want to trade in the different groups of security. For example, you have 10 lakhs rupees. You have 10 lakh rupees. If you if you invest in that 10 lakh rupees in only a single in a single security, or a single only at a one place, so will you get profit? For example, if you suppose unfortunately, if that part where you have invested will gives you loss, then your whole money will be drawn. So to avoid this situation, what we do of this 10 lakh, we invest the 10 lakhs in different securities or different sectors, which for to understand where we should invest how much in what type of securities, which we should include, which securities includes what proportion of risk. To understand all these things, we use the portfolio analysis or the portfolio management. Okay. So for example, these are the security 1, these are the security 2, this is 3, 4, 5, 6. Suppose you invested 5 lakhs here, but unfortunately it haven't give you much profit. But here, whatever the 2 here, 2 lakhs you invested here, another 2 lakh you invested here, and 50,000 here, and 50,000 on here, you have invested. Okay. So this have given you the profit. So whatever the loss, suppose this were 2 lakh, after a period of some time, this after when the market was high, you get the chance to earn profit, and you earn 1 lakh profit on this 2 lakhs. That's a great achievement. Na? So the same way, portfolio management is what is an art and science of selecting and overseeing the group of investments. Okay, it is a group of investment to meet the long-term financial objectives and risk tolerance of a client. Okay, and a company or an institution. Okay, portfolio management is about, it's an art and science of where here what type is done, where is the selection is done, proper screening is done of what about the group of investment that meet the long-term financial objectives, and how the risk can be minimized and how risk can be tolerated. Either it can be either it is subjected to a particular client, either it can be related to, it will be related to company or an institution. Okay, now let's understand what is risk management. Risk management is what, it's about, it's a process of identifying, assessing, controlling the threats to an organization's capitals and earnings. Risk management is what, it's a process of कि भाई चेक करना कि कहाँ पे रिस्क है, उस एरिया को आइडेंटिफाई करना, and how to that can be risk that can be minimized, and to what extent the threats can be controlled, to which are supposed to what, which are supposed to harm the organization's capitals and harm the earnings of the organization to a large extent. So to reduce or the abolish such threats, this risk management is used. Okay, this risk stem from a variety of sources, including the financial uncertainty, then legal liabilities, the technology issues, then strategic management errors, accidents, and natural disasters. So this is what risk management. Risk management, for example, those who whichever companies who faced the COVID, at that time this was a huge risk for the companies to sustain themselves. Many companies drawn. So at that time, you have to take proper you have to adopt proper strategies. If your strategy is not proper, your business will face difficulty in future sustainability. Then to legal liability, suppose government has a long time ago, government has banned the use of plastic. So at that time, many in the firms which were manufacturing the plastic or the plastic equipments, they faces issues. So at that time, there is their risk. How can that risk, such conditions can be tolerated, or how to overcome such situations? That it is used by the can be done by the risk management. Okay, now the capital asset pricing model. So जो रिस्क होती है, जो रिस्क असरटेन करने के लिए रिस्क को मिनिमाइज कैसे मिनिमाइज किया जाए, इसके लिए हम किसका यूज करते हैं? वी यूज द कैपिटल असेट प्राइसिंग मॉडल. द कैपिटल असेट प्राइसिंग मॉडल CAPM describes the relationship between the systematic risk and the expected return. It describes the relationship between the systematic risk and the expected return for the asset, particularly stock. Okay. पर्टिकुलरली स्टॉक. यहाँ पे बात किसकी होगी? यहाँ पे बात होगी कि एक सिस्टमैटिक रिस्क है और अनदर इज द एक्सपेक्टेड रिटर्न, यानी उस रिस्क में आप कितना रिटर्न एक्सपेक्ट कर रहे हो, इसका रिलेशनशिप जो होता है दैट इज डिटरमाइंड बाय द CAPM मॉडल, द कैपिटल एसेट प्राइसिंग मॉडल. द CAPM इज वाइडली यूज्ड थ्रू आउट टू फाइनेंस pricing risky securities and generating the expected returns. Means you are using what you are using the CAPM model for what purpose? For to price the securities. At what price you should sell or buy the securities, and how you should use finance for that security, which will generate the future returns to large asset in future. Okay. And how the risk can be used to get future returns from the assets which a company has. Then who are the developers of CAPM? The main developers of CAPM are the William Sharpe, John Lenter, Jack Tanner, and the Mosim. Okay, so this four names are most important. At least 2 to 3 times question has been asked from this topic. Okay, these names are also some once it has asked in match the column in December 2019. Then in December 2020, it was in December 2018 who has given that direct question was asked. It in another previous year question, old 2016 statement wise question was asked. So you should know these four names, keep it in mind, and or stick it in your mind with Fevicol, gum, Fevistick, whatever, but because these are very important. Okay, now let's understand that two main types of risk. One is the systematic risk and another is the unsystematic risk. First of all, understand the meaning. Systematic risk is what? Systematic risk is the hazard. Okay, it's a hazard which is associated with what? It is associated with the market risk or the market segment as a whole. Means whatever risk is whichever it is present in the market, it's called systematic risk. And unsystematic risk is what? It refers to the risk associated with the particular securities or companies or industries. Means that type of risk will be limited to a particular security. It can be either limited to a company or it can be either limited to an industry. Okay, so but the systematic risk jo hai, it is market oriented, or it can be available in the pestal factors. Means any type of risk is available in the business environment, like COVID, or any storm like thunderstorm like Amphan. So at that time, it is what? It's a systematic risk. The nature of the systematic risk is what? It is uncontrollable. You can't control the systematic risk. For example, if you want to, have you ever thought that the corona can be controlled? No. Why? Because it's uncontrollable in nature. And because unsystematic risk can be controllable. Why? Because it is internal in nature. Means if there is any type of fault in the management of the company, if it is resolved, and or it is rectified, then at that time the risk can be unsystematic risk can be considered. Now what type of fluctuating factors that affects the systematic risk? This is related to the external factors. External factors means what? The political factor, economic factor, socio-economic factor, then the cultural factor, technological, and the legal, and the environmental. So these are all the external factors, and unsystematic risk belong to the internal factor. Suppose you have not the good HR, good human resource, or you don't have a good equipment for the production. So these are the internal factors. So then the systematic risk affects the large number of securities in the market. For example, suppose there is a recession in the market, it will impact the prices of the securities to a large extent. Okay, different securities of many securities prices will get affected. Okay, then unsystematic risk, it will affect only a company. Okay, or it can be limited to only a particular industry if it rises, or it will only be limited to a particular security. Okay, then what are the types of systematic risk? Types of systematic include risk like interest rate risk, market risk, then purchasing power risk. These are the examples, some of the examples of systematic risk. In the unsystematic risk can be a business risk, and it can be a financial risk, which we have discussed in detail in our leverage topic. Okay, so the financial risk can be or the business risk, which are the part of unsystematic risk, can be what? Can be this risk can be diversified. This can be minimized. Okay, this can be minimized to zero extent. Okay, this can be minimized to zero extent. And these are the these are controllable risk, or these are the diversifiable risk. But now on the other hand, you can't diversify the systematic risk. Why? Because it is related to the external factors which are not part of your business. It can't be diversified, it can't be controlled, and if your business is working, your business is working in the industry, there will be no, either your business is existing or not, the presence of systematic risk will be there. But if your business is there, there may be unsystematic risk, or the unsystematic can be zero for your business, or that unsystematic can be up to large extent if your management is improper. But in the systematic risk, either your business exists or not, if the risk is high, at that it will be high, you can't do anything. If the risk is low, that can be low. Okay. Then protection, how can you can protect yourself? You will have to by asset allocation, you can protect yourself from the systematic risk, and from the unsystematic risk you can use the product portfolio diversification strategy to minimize the unsystematic risk. Okay. Now let's discuss the CAPM, assumptions of CAPM. Assumptions of CAPM are what? First assumption is what? The investment makes their investment decision on the basis of the risk return analysis. Okay. Investors are rational, they use logic, so they make proper investment decision on the basis of risk return analysis. Okay. The purchase and sale of the securities can be undertaken in infinitely divisible units. Okay. The sale and purchase and sale of the security can be what? Can be undertaken in the infinitely divisible securities. Remember that you can divide the security as unit, divide that security in n number of units up to infinite limit. Then there is a purchase of sale by a single investor cannot affect the prices. Suppose if a single investor is buying and selling a security, it will not affect its prices in the entire market. Okay. Then there is there is no transaction costs, or you can say there is an absence of transaction costs. There is no personal income taxes, or absence of tax, you can say. Then this involves the investor can lend to borrow any amount of funds at a risk free rate. Means here what it is saying, that the investor can borrow any amount of funds at risk free rate. भाई ऐसा तो नहीं होता, रेट रिस्क फ्री रेट नहीं रहता है, risky rate भी रहता है. So this assumption was quite unrealistic. Then the investor can sell short amount of any share. Okay. Then the investors share the homogeneity of expectation. Remember that this is important from the expectation, from the statement type question, like the investor will share the homogeneity of the expectation from the market. Okay. The expectation of the from the investors will be what? Will be homogeneous in nature. Now let's discuss the formula of the CAPM. Formula of the CAPM is what? Expected return is equal to risk free rate plus beta into RM minus RF, means market risk minus risk free rate. Sorry, this ER is what? ER is the expected rate, RF is the risk free return. This RF is what? The RF is the risk free return. Okay. Then this is the beta is the what is the market risk, and E is what? RM is the what? RM is the expected market return. Okay. This formula is quite let me tell you another. Now let's understand what is beta. Beta is what? Beta is the unsystematic risk which is available in the market. Suppose when the beta is equal to 1. Now let's understand, when the beta is equal to 1, the expected return of the stock or the expected return of the security will be equal to the expected return of the market portfolio. These conditions are very much important. You will have to keep in mind as it is. Okay. अगर बीटा 1 है तो क्या होगा? जो expected rate रिटर्न है सिक्योरिटी स्टॉक का, वो किसके बराबर हो जाएगा? वो एक्सपेक्टेड रिस्क रिटर्न जो है मार्केट पोर्टफोलियो, ओवरऑल मार्केट पोर्टफोलियो का जो रिटर्न है वो किसके बराबर हो जाएगा? एक्सपेक्टेड रिटर्न ऑफ अ पर्टिकुलर स्टॉक. Okay, if the beta is greater than 1, if the beta is greater than 1, then the investment will be very aggressive in when the aggressive there will be what? There will be aggressive investment, and the expected return of the stock will be greater than the expected return of the market portfolio. Means जो expected return है आपका एक स्टॉक पे जो expect कर रहे हो आप रिटर्न, वो किससे ज्यादा होगा? ओवरऑल जो मार्केट पोर्टफोलियो से जो रिटर्न आएगा उससे ज्यादा होगा. And there will be what? There will be steeper slope of the characteristics line. The characteristics line will be have a steeper slope. Okay, and then in the last, if the beta, if the beta is less than 1, if the beta is less than 1, there will be defensive investment. Means you will properly think and then invest in the market. Okay, there will be defensive investment here. Expected return of the stock will be less than the expected return of the market portfolio. Means आपकी सिक्योरिटी पे जो रिटर्न आपको मिलेगा वो ओवरऑल मार्केट पोर्टफोलियो में जो रिटर्न है उससे बहुत कम होगा. एंड हियर जो कैरेक्टरिस्टिक्स लाइन का स्लोप है वो क्या हो जाएगा, वो फ्लैटर हो जाएगा. Now let's understand what you should do as per the conditions. First, the CAPM. If the value of the CAPM is less than the expected return, buy the security. You will have to buy the security. Here the reason will be what? Why you should buy the security? Because the CAPM here the stock is undervalued. आपकी stock को undervalue किया जा रहा है, so you should buy the stock. And the nature of that nature of return is what? The nature of the return is more than what is what you should give. Okay, what it should give, it will be more than that. It means जितना आप expect कर रहे हो उससे आपको ज्यादा ही मिलेगा. अब अगर CAPM की वैल्यू जो है, CAPM की वैल्यू अगर ज्यादा हो जाती है एक्सपेक्टेड रिटर्न से, अगर CAPM की वैल्यू ज्यादा है तो इस केस में क्या करोगे? यू विल सेल योर सिक्योरिटी. व्हाई? बिकॉज द स्टॉक इज व्हाट? ओवर वैल्यू. क्योंकि अब उसकी वैल्यू बढ़ गई है, तो यू कैन सेल योर सिक्योरिटीज. एंड हियर द नेचर ऑफ रिटर्न विल बी व्हाट? द नेचर विल बी लेस. द रिटर्न विल बी लेस व्हाट इट शुड गिव. मींस जितना उससे आपको मिलना, जो जितना उसने देना चाहिए था उससे आपको क्या, वो कम रिटर्न देगा. बट अगर आपने बाय किया है जब सिक्योरिटी अंडर वैल्यू है और आपकी CAPM की वैल्यू किससे कम है? एक्सपेक्टेड रिटर्न से कम थी, तो उस टाइम में आप जितना रिटर्न जो है, आप जितना एक्सपेक्टेड रिटर्न कर रहे हो उससे आपको ज्यादा मिलेगा. जितना उससे देना चाहिए उससे आपको ज्यादा ही मिलेगा. You will get more than your expectations. But when the CAPM has a greater value than the expected return, you should sell, but it will generate the lesser return as per your expectation. Then when the CAPM is equal to expected return, you should hold your security. Here the reason is the security is correctly valued here, and the exact return what you should give, it will give you to you. Okay. So this is the three main conditions which you should know related to CAPM. Now let's understand what is security characteristics line. Characteristics line is a straight line. It's a straight line formed using the regression analysis. What type of analysis is used in security characteristics line? Is the regression analysis. This is a very much important from a one-liner or a statement-based question. It summarizes the securities systematic risk and the rate of return. Means देखो जो CAPM है, here only what type of risk will be used? Here only the systematic risk will be used. Here there will be no scope for the unsystematic risk. The characteristics is also known as the security characteristics line. The characteristics line is also known as the security characteristics line. The characteristics line is created by plotting the securities return at the various points in time. Okay, here you will plot the returns from the securities at points at a time. This on the y-axis on this chart measures the excess return on the security, and the excess return is measured against the risk-free rate on the return, and the x-axis will excess return is measured against the risk-free rate of the return. The x-axis on the chart measures the मार्केट रिटर्न इन एक्सेस ऑफ द रिस्क फ्री रेट. यानी रिस्क फ्री एक्स पे आप क्या दिखाओगे? एक्स एक्सिस पे आप दिखाओगे जो मार्केट से कितना रिटर्न आ रहा है आपको रिस्क फ्री रेट के एक्सेस में, और जो वाई एक्सिस है उस पे आप क्या दिखाओगे? जो वाई एक्सिस है उस पे आप दिखाओगे कि आपका जो एक्सेस रिटर्न है, एक्सेस रिटर्न जो है वो रिस्क फ्री रेट ऑफ रिटर्न के कितना जाए. अब आती है सिक्योरिटी मार्केट लाइन. सिक्योरिटी मार्केट लाइन इज व्हाट? सिक्योरिटी मार्केट लाइन इज अ लाइन ड्रॉन ऑन द चार्ट दैट शोज that observes the graphical representation of the capital asset pricing model CAPM, which shows the different levels of the systematic or the market risk of the marketable securities. यानी ये क्या बताएगी, ये जो है ये क्या होगा, एक ग्राफिकल रिप्रेजेंटेशन होगा, जो क्या सिक्योरिटी मार्केट लाइन होगी वो क्या होगी, एक ग्राफिकल रिप्रेजेंटेशन होगी किसका, सीएपीएम मॉडल का, जो किसके बीच में रिलेशनशिप बताएगा, डिफरेंट लेवल ऑफ रिलेशनशिप बताएगा, सिस्टमैटिक रिस्क और मार्केट रिस्क और जो भी मार्केटेबल सिक्योरिटीज हैं इनके बीच में। और इसको किसके अगेंस्ट में प्लॉट करोगे आप, इसको प्लॉट करोगे एक्सपेक्टेड रेट के अटेंस में ऑफ द एंटायर मार्केट एट एनी गिवन टाइम. Okay, now there is a capital market line. In the capital market line, it's a CML it represents the portfolio. Okay, CML represents the portfolio that is optimally combines the risk and the return. Here combination of both will be used, risk and return. It is the theoretical concept. What? It's a theoretical concept. Here all the portfolio are optimally combined, means पूरे पोर्टफोलियो का ओवरऑल जो दिखाएगा वो कौन दिखाएगा, ओवरऑल रेट ऑफ रिटर्न जो है और जो मार्केट पोर्टफोलियो है किसी रिस्की एसेट्स, ये कौन दिखाएगा, ये दिखाएगी कैपिटल मार्केट लाइन. ओके, अंडर द कैपिटल एसेट प्राइसिंग मॉडल सीएपीएम, जितने भी इन्वेस्टर्स रहेंगे वो क्या एक ऐसी पोजीशन चूज करेंगे कैपिटल मार्केट लाइन में जो इसकी क्या रहेगी, जो इक्विलिब्रियम पोजीशन रहेगी, वेयर देयर विल बी नो रिस्क नो रिटर्न. ओके, एंड हियर बोरोइंग और लेंडिंग एट द रिस्क फ्री रेट. यहाँ पे बोरोइंग एंड लेंडिंग में क्या रहेगी, रिस्क मींस बोरोइंग एंड लेंडिंग मींस समहाउ रिलेटेड टू द बाइंग एंड सेलिंग, एंड जो रिस्क रेट कौन सा रहेगा, यहाँ पे रिस्क फ्री रेट रहेगा, सिंस दिस maximizes the return for a given level of risk. Okay, now let's understand from the here the y-axis indicates the y-axis indicates the expected risk, and the x-axis indicates the x-axis indicates the expected risk, and y-axis indicates the expected return. Okay, here it is the risk free rate indicated in the percentage terms here, and this is this is the capital market line. This is the capital market line in the and here the ideal market portfolio, and here this dotted things are what the dotted is the systematic risk available, and here the inferior portfolio and individual assets are shown under this, and this is the security characteristics line. This dotted line which is drawn through the regression analysis is what okay, oh sorry, this line is what, this line is the security characteristics line. Okay, if you want to see from here, this here you will get the risk free risk premium. Here is an availability of what, here is an availability of risk premium, or here the on the vertical axis it has showed the market return return or the and the risk free rate. On the horizontal axis you have the beta of the market, beta is equal to 1. Here there will be point of equilibrium when the beta is equal to 1, and here it indicates the market risk. Okay, market risk. If the risk-free rate is normally taken as the yield at a long-term government bond in the country where the project company is based. Okay, this is just an example. You can ignore it. So, and this is the SCL, security characteristics slide. Now, the CAPM model is widely used return model that is simple and easy to calculate. Moreover, it equates the relationship between the rate of return and risk. Okay, so it's a theoretical form, so it can be useful in the empirical researches and testing. CAPM can be used in the empirical type of researches. It's a vital in calculating the weighted average cost of capital. Okay, let me tell you the CAPM model. The CAPM model is what? CAPM model is the best method for determining the overall cost of equity. Okay, the best method for determining the cost of equity. Why? Because it considers both type of rates, means one is the risk-free rate and the expected return. Okay, it's a vital in calculating the weighted average cost of capital, and it calculates the cost of equity as a major component of WACC. Okay. And it is comparatively much better method of calculating the cost of equity. This we have already discussed. And while exploring the business opportunities, if the business mix and the financing differ from the current business, then other return models, specifically the WACC, cannot be used, but the CAPM can easily be used. Means if your business model and the return is somehow different from your financing decisions, so at that time you can use the CAPM to analyze the availability and the scope for generating returns from your business activity. CAPM is superior to another return model in providing the discount rate to used in the investment appraisal. Okay. Now, what are the merits and demerits of CAPM? The merits means eliminates the unsystematic risk, and it considers the systematic risk. Then investment appraisal, it is best for investment appraisal, and it is easy to compute. Okay. Now, what are the demerits? Here, unrealistic, too many assumptions which are in which many are unrealistic. Then assigning values into the CAPM can be vary from security to security. Here, variation will be there, and here ability to borrow at risk-free rate. Then determination of the project and proxy beta. Proxy beta means what? There is a chance for chance of error. Now we have the arbitrage pricing theory. Arbitrage pricing theory was given by the Stephen Ross in the 1976. Arbitrage pricing theory, APT, is about, it's a multi-factor asset pricing model. Okay, multi-factor asset pricing model. The SML was the CAPM was what? CAPM was a single factor asset pricing model, but it is what? APT is a multi-factor asset pricing model. It is based on the idea that asset return can be predicted using the linear relationship between the assets expected return and the number of macroeconomic variables. Okay, it is the relationship between the asset expected return and number of macroeconomic variable. Okay, here there only one macroeconomic variable beta was considered, but here different macroeconomic variables are considered under the systematic risk. Okay, which is useful tool for analyzing the portfolio from the value investing in perspective. Okay, in order to identify the securities that may be temporarily mispriced. Okay, so in securities identification में क्या होगा कि जो securities हैं वो कहीं ना कहीं temporary level पे इनका misprice भी हो जाए. Okay, अगर आप उस पे से इन्वेस्ट करने के पहले वैल्यू कैलकुलेट करते हो तो कहीं ना कहीं सिक्योरिटी जो है वो थोड़ी सी आर्बिट्रेज एपीटी के अकॉर्डिंग मिसप्राइस भी होती. नाउ व्हाट आर द assumptions of the APT are there are three major assumptions. First is what? The capital markets are perfectly competitive and no transaction cost, means there is what perfect feature of perfect competition will be there and the no transaction cost. The assumption makes possible that the arbitraging of mispriced security. Okay, here arbitraging means what? You will buy from another market at a lower cost and sell it in different market at a higher cost. Okay, thus forcing equilibrium price. Okay, then investors always prefer more wealth to less wealth. Okay, means here the investors prefer wealth maximization. Then various factors give rise to returns on securities and the relation between the security return that these factors are linear. Okay, is linear. Various factors give rise to the return on securities and the relationship between the security return and these factors are what? These are linear in nature. The stock sophisticated process. Okay, the sophisticated process, the assets return can be expressed as a linear function. It can be expressed as a what? It's a linear function of a set of risk factors or indexes. Okay, so the I will recommend you to keep this assumption in mind, but the assumptions of CAPM is 10 times more important rather than this APT. Why? The APT is the questions asked from the APT are not much as compared to the CAPM. CAPM is the I said 200, 300, whatever you want, whatever times you want to change, say it is 200 times, 300 times, 400 times is important as compared to APT. So if you don't, you are facing difficulty in remembering the assumptions of APT, you can still skip it to some extent, but don't skip the assumptions of the where it has gone, the assumptions of the CAPM. That is super important. Now, what is the formula for the, this is formula for the, not CAPM, this is formula for APT. This is formula for the APT. Expected return on I, risk free beta 1 plus RP 1 plus beta I2 means index 2 into RP square plus beta KN into RPN. Okay. So risk free is the risk free rate of the return. Beta is what? Is the sensitivity of the assets or the portfolio in relation to the specified factors, and RP is what? RP is the risk premium on that specific factor. Okay. This now let's understand the difference between the CAPM and APT. APT is what? It's a equilibrium, means no arbitrage opportunity. There is no arbitrage opportunities in the APT, but in case of CAPM model, it is based on the unobservable market portfolio. Okay. Then the APT equilibrium is quickly restored, even if only few investors recognize an arbitrage opportunity. Here it rests on the mean variance efficiency. The actions of the many small investors restore the CAPM equilibrium. To means here the second point says that to gain the CAPM, to gain back the CAPM equilibrium, to restore the CAPM equilibrium, n number of actions taken by the taken by small investors, then only if they are efficiently taken, the equilibrium position can be achieved. Otherwise it will not be achieved. But in case of in case of APT, if small number of investors will recognize the arbitrage opportunity, that equilibrium position can be restored easily. The expected return beta relationship can be derived without using the true market portfolio. Without using the true market portfolio, the expected return from the beta can be derived in case of EPT, but in case of CAPM, it describes the equilibrium for all assets. So that's all in this CAPM and APT. I hope this portion is clear to you. So that's all about today's session. If you like the session, just hit the like button.